So good morning and welcome to At the Coalface. My name is Roy Thompson. I head up MHA Carpenter Box Financial Advisors. I've got with me Tom Ledger. So Tom is an investment manager at LGT Vestra, one of our investment management firms that we use. I thought today we'd look at, if we think over the last couple of weeks, we've seen perhaps some increased volatility in stock markets, not just here in the UK, but around the world. They've done quite well since the beginning of the year, fairly positive in terms of how they were performing, but the last week or two has been a little bit more choppy. Tom, I don't know if there's sort of specific reasons that you might want to share for that. Certainly US Treasury are talking about increasing interest rates. So I don't know if that's a factor that you might want to cover off.
Yeah, absolutely. Thanks, Roy. So I think the kind of story year to date has been the kind of diverging forces of really good growth numbers. You'll have seen last week that the US growth for the year is predicted to be around 7.5%, which is really strong. We haven't seen those rates in a long time. And that's mainly been driven by the amount of stimulus which has been put in the market, not just last year, but also this year. On the back of that, you've also seen inflation expectations increase quite a lot. And although the inflation number itself isn't running away from where we'd like it, it's sitting around the long-term central bank rate. The market has been spooked a little bit by that and think that the central banks around the world, particularly the Fed in the US, might have to raise interest rates sooner than they are otherwise thinking. And that does have an impact on some of the sectors in the market, particularly tech, which have been doing very well over the last few years, which is why you've seen this sort of wobble. I think from an investment strategy perspective, you need to try and figure out whether this spike in inflation is going to be transitionary or whether it's start of a long-term trend. We're not really going to know that for a few more quarters, and we start seeing what happens possibly Q3 this year, if not Q4, whether it starts to drop off. But from our perspective, we still think at the moment this is going to be transitionary uptick, and then it will come back again. And that's mainly driven by really big themes of the unemployment still being very high, technology is really still driving a lot of kind of efficiencies across loads of different industries, and also populations are generally living longer, and that again is supportive of a low inflation environment.
Okay, so you mentioned interest rates, sort of a view that interest rates might start rising sooner. What sort of timescales are they talking about from that perspective? So
if you look at the Fed, which is the US central bank, and it really is the kind of the rule of thumb, really, they're looking at 2023 for their first interest rate rise. Now they're only looking at one in that year, and the market itself thinks they may do two. We're not talking about a massive increase in rates here, but because we're so low, we're pinned to zero, any move is meaningful from a market perspective. And that's what's kind of been the change over the last couple of weeks is that they think they might have to raise rates quicker to take a hold of this inflationary spike.
Okay, so that might be brought forward from 2023 to it might be sooner, and it may even be quicker. I guess that's another potential outcome from that, depending upon how inflation progresses over the course of the year.
Absolutely. I mean, I think there's also something to remember, because the debt of these central banks is so large. They are incentivized to keep that interest rate as low as possible to help them fund this debt over the next few years. Obviously, in time, they will look to increase rates to kind of rebalance the economy. But for the moment, and hence why you'll read a lot about longer rates being lower for an extended period of time, it's because they need to fund this massive debt pile and pay it down over a series of years, if not decades. And that's a kind of key feature.
Yeah, and arguably from a government point of view, the notion of a little bit of inflation with low interest rates, I've read a number of articles now saying that, exactly as you say, it suits governments, and it might be a departure from what we've seen economically before, where there's a very close correlation between interest rates and inflation. There might be a slight decoupling of those two, so you'd run with higher inflation but still retain low interest rates. So it'd be interesting to see how that evolves. I guess here in the UK, week coming up, we've got an interesting week, the budget. I think you were talking just before we came on here. You don't typically look forward to a budget, but I think a lot of people looking at, watching with interest this week. We obviously don't know what's going to be in that budget, but there's been much talk about capital gains tax. I don't know from an investment point of view whether that changes LGT's Vestra's views on how things should be structured, or whether it gives sort of cause for concern or anything of that nature from an investment perspective.
Yeah, I mean, it's obviously difficult to comment anything exactly. We don't know what's going to come out from the Chancellor. Obviously, tax is always something which we take into account when we're managing people's investments, particularly advisors like yourself and through clients who are always encouraging people to make sure they're using their tax wrappers as much as possible. Obviously, some people have assets outside of those wrappers, and harvesting gains when it's appropriate to do so is a key part of anyone's investment strategy to make sure that that tax drag isn't too much on the portfolio. That being said, we try not to let that kind of tax element implicate the investment strategy too much. We think, generally our investments are longer term and we'd like to hold them for as long as possible. And we try not to trade too much around the size to increase that kind of crystallized gain over a long period of time. So, we'll see what the Chancellor has to say. We just think, with CGT rates being at historic close, it's probably an easy win for the government to maybe target that a little bit. But let's obviously just be mindful that CGT rates were a little bit higher 3 years ago, and that didn't impact many people's investment strategies. So it's nothing to be alarmed about, I don't think, but something obviously we'll take into account when we know more.
So from an investment point of view, not predicting a big change there, I guess, we don't know ultimately what will be said. I guess from a financial planning point of view, from our side of the business, that, coming up to the end of the tax year, crucial that people look to use their tax wrappers, pensions, ISAs where they can, and that might become even more important as we move forward if taxes increased on investment returns. So be interesting to see how that one plays out. But Tom, thank you very much for joining us today. Much appreciated. I'm sure we'll catch up in the coming weeks. Thank you very much.
Thanks, Roy.